I'll be explaining what quantitative easing is in the simplest and easiest way possible. But first, to understand quantitative easing, you need to know what a central bank is. So, what is a central bank? A central bank is a special bank that controls a country's money and interest rates. It works with the government but has different jobs. The government makes laws and decides spending, while the central bank focuses on keeping the economy stable by managing money and inflation. So here is a step-by-step explanation of what quantitative easing is. 1. The central bank creates new money electronically. It doesn't print physical cash. It just adds money into its computer system, like adding money to your online bank account using cash you haven't physically deposited yet. The money shows up digitally, but you don't see any real cash. 2. It uses the new money to buy government bonds, which are like loans to the government that will be paid back with interest later. Think of a government bond like a note that says, the government owes you £100 and will pay it back in a few years with some extra money. 3. The central bank buys these bonds from banks, pension funds, and big investors who already own them. 4. Those banks and investors get the new money. Now they have more money to spend, invest, or lend. 5. Banks now have more money to lend to people. That makes it easier for people to borrow money to buy homes, grow businesses, or invest. So to conclude, quantitative easing puts more money into the economy by helping banks lend more. This makes it easier for people and businesses to borrow, encouraging spending and investment that boosts overall economic growth and helps keep the economy stable.